Hello, it's Adil bringing you a review of the FTSE 100 for Wednesday's trading, the 26th of November 2014, bringing you an intermarket analysis perspective of the FTSE 100. Okay, so the Shanghai, as you can see, quite bullish ever since the rate cut, and that certainly did propel the FTSE, well, it was supposed to propel the FTSE higher from the outset, and unfortunately didn't. Now, basically overnight, we had the Shanghai and the Hang Seng higher, obviously based on rate cuts and based on potential for more stimulus down the road. Okay, so the Shanghai and the Hang Seng were higher, but we had the Nikkei lower. Okay, so Shanghai Hang Seng higher, but the Nikkei lower, as you can see, although it's been recalibrated now to a certain extent. Okay, so Nikkei lower overnight. Okay, so that was basically what we came into. In terms of the economic data, in the morning we started off with, and there's nothing really overnight other than yesterday. Obviously, the consumer confidence data out of the US wasn't exactly spectacular, and that's obviously kept a lid on US gains. Although the Nasdaq seems to be steamrolling ahead ever since the news of Twitter potentially purchasing shots, and even though Hewlett Packard earnings were weaker than expected, so from that perspective, it certainly is, or it does remain weak. Okay, from the FTSE's perspective, the OPEC oil cut is really dominating things. Okay, we did have Thomas Cook shares down almost 20%, due to the, I think it was CEO or one of the board members resigning. So that was certainly putting pressure on the FTSE, but it's all about OPEC oil cuts, okay, because we've got oil now almost down to $73, and the FTSE is a commodity index, so therefore it will feel the pinch and will definitely remain weak. Now the Dow obviously did remain weak. The S&P certainly is pushing into the highs, although it's still at that resistance level on the 2070. But Nasdaq really was the outstanding index today. Certainly was moving higher. Okay, so let's see how we anticipate this. So first of all, we had the inflation data out of Germany in Europe. Okay, that came out slightly higher than expected, so therefore that put a damper on the possibility or probability of more QE. Okay, then when that was actually putting a damper on things, and the markets were certainly coming under pressure, okay, and it was hurting sentiment, etc., etc. Then we had an announcement from Mr. Constatio, who started to talk up QE, or the possibility of QE. Okay, and that obviously sent the markets higher. So first of all, we obviously started off from the outset. So the FTSE 100, if I just give you an explanation or an insight, basically we opened up, we went as low as 6730. We rallied, obviously to the high here at 6765, mainly due to the fact that even though we had a weaker consumer confidence data the night before, and even though the Aussie, Kiwi, commodities were all weak, yet the FTSE certainly wanted to move higher. Okay, and stage a reversal. Now, maybe that was due to individuals buying in anticipation of the GDP data that was supposed to come out. Maybe they had access to inside information. I don't know. Maybe it was positioning for the day. Obviously, the first half hour is quite important, etc., etc. Although we happened to top out. Once we topped out, obviously we did have news from the Saudis in terms of their intentions of not doing a cut. And then we had a lot of noise from the Russians saying that they were not going to cut production, even if oil were to drop below 60. Okay, so it certainly is a game of Russian roulette at present, and or should we say poker. Really, it's self-destruction. Really, to be honest with you. Nobody really wants to flinch on the export side of the equation because of the revenue that's going to be lost. Obviously, if any one of those nations were to reduce supply, obviously it does result in loss of revenue. Whether the higher oil price can compensate for that is yet to be determined. Okay, given the fact that also Iran is now thinking of increasing production, given the fact that there's talk of their sanctions being lifted if they were to cooperate with regards to the nuclear de-escalation. Okay, so that's another factor anyway. So, but from our perspective, economic growth in the Eurozone remains weak. Economic growth in Europe remains weak. As we already know, economic growth in China is weak, and I'm just reading an article at the moment. Just tweeted out with regards to China reducing its growth target to 7% and below. Okay, in order to risk of a hard landing. Okay, so they're trying to cool the slowdown or smooth out the slowdown. Okay, and that's one of the reasons why oil prices are obviously been under pressure. Now, the situation that we find ourselves in. Okay, so the FTSE itself, obviously, as we already know, was certainly coming under pressure, given due to the fact that the talk of OPEC not cutting supply, although there was some talk the day before that they would, etc., etc. So when that transpired, the FTSE itself would obviously come under pressure, given the fact that it's a commodity index. Okay, given the fact also, like I said, that the inflation data out of Germany came in. Let's see where my inflation data is gone. Bear with me. Okay. So yes, inflation data that came out slightly higher than expected. So that obviously reduced the probability of QE. Then you had the consumer confidence data out of Italy that came in slightly better than expected. And then, as we all know, the talk of Mr. Constantio, etc., later on, that certainly lifted the markets. But for now, the GDP data itself, when it came out at 9:30, that certainly put pressure on the market, and that certainly indicated to sell off, because there were certain components within that GDP figure, especially business investment was lower than expected. Okay, so that was certainly a negative factor, and there were all the negative factors as well with regards to the GDP component. So that was certainly bearish, and also the CBI data that came out at 11 o'clock thereafter was also negative. Okay, and then on top of that we had US data that was obviously negative as well. We had initial jobless claims, certainly negative, and we also had other factors. There's another factor as well that was negative with regards to that. Chicago PMI, that's it, and the consumer confidence, although they did come out slightly better than the day before. But the new home sales, that was certainly, your pending home sales, was certainly negative as well. So overall, with regards to FTSE, it's all about commodities. Okay, so the GDP data that came out was interpreted as being negative, and also we did have some comments from Mr. Carney stating that regardless of the pessimism and the weaker growth from Europe, we were still going to go ahead and obviously raise rates, and sterling certainly started to rally. So whenever you have a sterling rally, that puts FTSE under pressure. So if I bring up a chart of sterling, you should be able to see we certainly had a rally in sterling on those comments, on the back of those comments. So it was irrelevant, more or less, exactly what the GDP component was, because Mr. Carney has stated to you that he's going to raise rates regardless. Okay, because whatever factors he's looking at, etc., etc., given the fact that GDP did come in line, but like I said, there were certain components that were indicating bias negative. But even if that economic data did come out strong, Mr. Carney's comments would have triggered the actual tapering phase, just like that's like they did in America. So whenever you reduce QE and you start to raise rates, then that obviously is negative for the markets. And regardless of how good the economic data is, that will certainly spook individuals within that market. Adding the fact, obviously, OPEC is not cutting, then that obviously is a double whammy. And given the fact that Thomas Cook certainly had the sentiment bearish regardless, that certainly didn't bode well. There was also another factor with regards to the FTSE, if I can remember correctly now, with regards to the FTSE and why we were weak. Bear with me. So TUI travel due to Thomas Cook, we already know. Okay, Thomas Cook group shares were the story of the day. That's really it, I think, to be honest with you. Led the blue chips with 3.7 Invesco, Calimo Securities. Yep, there was nothing else other than that, to be honest. London highlights, Motive, etc. So that's basically it. Okay. So sterling higher, FTSE lower. That's basically the relationship I think we've all become accustomed to now. Now, if you look at the daily chart of the FTSE 100, this is quite important. If I just bring up the daily chart of the FTSE, which I think I've already shared. Hey, bear with me. Okay. So FTSE 100. So basically, we've got the inverted head and shoulders formation. Okay. So you know the reason why obviously the FTSE was under pressure because of the OPEC not cutting supply, and that obviously hurts commodities. Commodities lower, and the FTSE generally tends to be lower. Adding the fact that GDP, certain components of that were negative, and given the fact that sterling started to move higher on hawkish comments, all those factors certainly don't bode well. Okay. Initially we had Mr. Constantio. Well, initially the inflation came out slightly higher than expected in Germany. That obviously dampened the probability of QE. Then we did have some comments on QE, or pro QE comments, that created a short squeeze, but then those comments were certainly denied, or not denied, but basically negated by other comments stating that they'll have to investigate and discuss the option of QE in 2015, and or before they do discuss QE, they will have to review every other policy that they've applied, and then obviously QE will be the last option. So that certainly negated the previous comments, and hence the reason why we had a nice rally in the euro around the 1.25 figure. So a higher euro is again very similar to a higher sterling, and that obviously causes a negative environment for equities. Okay, that's basically how we interpret it. Okay, so daily chart. So let's have a look at the technicals now. Now that we know that what the fundamentals are. Okay, so daily chart. Ever since we've obviously closed this or hit this 6770 inverted head and shoulders target, the FTSE has been meandering. Okay, has been relatively weak. We've had two dojis in a row now. The highs have been rejected. Anywhere around the 6760 region gets rejected. So basically 6770 is a solid resistance level. Previous support equals resistance here as well. Obviously we pierced the 200 MA, so we're certainly into resistance now. If I bring up the chart to FTSE 250, you'll realize again we are into horizontal resistance, pierce the 200 MA. Although the inverted head and shoulders target certainly has room to run, but given the fact that obviously sterling has moved higher, then that obviously should explain it all to you anyway, regardless. Okay, so FTSE 250 heavily reliant on exports. Now the FTSE Volatility Index is certainly building a base here. So once it's building a base, what's it trying to tell you? Given the fact that you've got OPEC not cutting, okay, which again is going to hurt commodities, given that oil is currently at $73. Okay, given the fact that we've got global equities almost at the highs, which I'll probably try and do a European video and a US video as well, trying to explain. Then this certainly, given the fact that this volatility index is into support, and given the fact that volatility index moves inverse to the FTSE, it indicates that we are going lower on the FTSE now. Given the fact that the article of this read, China seen lowering growth target, and there are rumours of the PBOC spreading. That's what's caused a short squeeze late in the US session, which I very much doubt, and we'll see exactly what transpires overnight. But having said that, the Shanghai and the Hang Seng and the Nikkei are certainly into resistance territory, especially given the fact that the Nikkei was negative overnight, and USDJPY is currently hovering at the 1176 level. So the 118 certainly is being solid resistance, and given the fact that the yen is now into support and starting to look bullish. If I bring up the chart of the yen, so you got a 60-minute chart of the yen, you got downward sloping contracting wedge, we've broken out. We're potentially making a higher low here, and then obviously starting to move higher on obviously a short squeeze and looking to close the gaps above. So if so whenever the markets are in risk off territory, that generally means that gold is well bid, the Swiss franc, yen and dollar is well bid. Okay, and obviously the bond market gets money flow going towards it as well, given the fact that it's looking for a safe haven. So watch those three areas. Okay, so the dollar, and now as you know, the yen, Swiss franc generally catch a bid because of the dollar, and given the fact that it's a safe haven currency. Okay, so and given the fact that the yen carry trade looks like it's going to be unwound. Okay, especially given the fact that 118 we've failed to penetrate and move higher. You can have a look and observe this via the USDJPY chart, which a lot of people are ignoring from my perspective. You can just have a look at it here. So you got a 4-hour chart. We failed really on the 4-hour chart to actually make a higher high. We've made a higher low, and we certainly are struggling right here. So potential here for a double top on the 4-hour chart, and once we get a double top, what generally tends to happen next is the fact that we're going in this direction. Okay, if that's the case, and that's certainly telling you that the US markets have reached the top, and certainly want to reverse in the opposite direction, and it's a fake out with a lot of these indexes. Okay, so again, these are all factors that I'm watching and observing. Same thing with regards to the Dow transports. Usually it's a flag, a warning sign, and you can see there H&S formation. So if the yen is in a bullish formation and the USDJPY is in a bearish formation, and obviously your FTSE itself has basically hit its inverted head and shoulders target, and given the fact that OPEC is a state that is not going to cut production, so that itself will be negative for the FTSE. Now you've got the FTSE All Share Index, AIM All Share Index into the 50 to 61%, and put in a red candle today. So certainly some weakness there. Okay, so we look at the sector breakdown. Okay, so you have your pharmaceutical sector here, and what pattern do you see? You've got a H&S formation, left shoulder, head's gone in there, right shoulder, bang, down we go, testing this 200 MA. Okay, also you got an unfilled gap below. So your 60-minute chart in the pharmaceutical sector is bearish on the FTSE itself. Okay, so let's bring up the 60-minute chart of the and this is your chart of the banking sector. So from my perspective, this is not looking good. Okay, so you've got the resistance here which we've held, horizontal resistance here, and again you've got a similar type of pattern. So you've got the left shoulder there, you've got the head that's gone in, you're looking for a right shoulder because the bounce today was pretty meager, and down we go. So you've got an unfilled gap that needs to be closed down here. So what do you think will happen to the banking stocks? Down we go. So what's that telling you in advance? It's telling you, okay, given the fact that also, one more point as well, the US economic data that came out overnight, well today, was all week, indicated bearishness. Why did the stock markets rally in the US? Everybody knows, low volume, okay, manipulation. So given the fact that Thanksgiving, they want the markets to stay afloat so that they can keep everybody happy and everybody shopping till they drop. Okay, so gap fill below. Okay, so again, banking sector is certainly not looking bullish. Oil, do I even need to go even elaborate and discuss this with you? As you all know, with regards to OPEC, etc, 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 the high above was really, I mean, let's just say, wasn't exactly strong. And again, what pattern do you see here from my perspective? Given the fact that the sentiment, etc, remains pretty dour. Left shoulder, head, and right shoulder, bang, down we go. Okay, so and then you've got an unfilled gap below that needs to be closed here. So again, it looks like it's the it's about those gaps. Again, retail index. What do you notice straight away, folks? I mean, this just is, it's not on one index. I mean, you can see it on all. Look at this left shoulder, head, and now we've got a bear flag formation consolidating within the red candle. Down we go. Okay. Now there was an article with regards to Sainsbury's talking about chicken being contaminated, and apparently the Food Standards Agency is going to be releasing that report. A lot of these supermarkets are going to be in trouble because 6 in 10 chickens are all contaminated. So watch out for that. Also with regards to the potential chicken scare from we had flu, was it the chicken virus again? I can't remember now. It was in one of the Yorkshire farms. Okay, so again, watch out for that. It's not really good. And we already know the situation with regards to supermarkets and the retail sector as well. Okay, and especially given the fact that Thomas Cook today warned and stated that not many individuals are travelling abroad. That's not exactly a good sign, is it? So just keep an eye out for that. Okay, so right flag, right shoulder here, retailers, and potentially down we go. Okay, now let's bring up any other sector that we can observe. Now, one thing that I have noticed as well, and this is something that's certainly very important for you to observe as well, ever since the Chinese rate cut, the Aussie and Kiwi have failed to rally higher. It's not exactly a good sign, is it? That's certainly a warning sign. And also with USDJPY stuck at 118, again, it's a warning sign. Okay, so certainly read all these signs. It's very, very important as a trader. Okay, so the mining sector. Okay, so this is a 10-minute chart. Let's go to a 60, try and get a better understanding here. I mean, this has been weak ever since. Okay, now the mining sector, I'm not going to comment as much because obviously we do have the concerns, but we do have the gold price certainly is bullish. But from a 60-minute chart, there's certainly a strong argument here for inverted head and shoulders formation. But having said that, given the fact that OPEC is not going to cut, then that obviously does not help other commodities in the sector. So just watch out for that potential double bottom scenario. But again, we need to remain open to this potential inverted head and shoulders, and we'll see exactly how that transpires tomorrow. Okay, let's see if there's any other sectors I can quickly elaborate on before I go on to the FTSE itself. Okay, let's have a look. I mean, the copper itself is not exactly strong, so I'm not sure how the miners are going to catch a bid. Okay, let's have a look here. So mobile telecoms. Okay, so one thing that I need to discuss with regards to mobile telecoms, which has really been worrying me, is the fact that even with the bid with regards to BT bidding for O2 and BT obviously bidding potentially for EE, we still failed to go higher. So therefore, all I can think of is when you have a bullish news flow in the background with regards to a certain industry, and that industry fails to propel higher on rumours of a bid, etc., and obviously mergers and acquisitions and so on and so forth, then that generally does indicate bullishness. So, but when that fails to happen, so when good news fails to propel any stock higher, then you know that's a warning sign, okay? Because it's more than likely it's been priced into the market already. Now you already know that we have two unfilled gaps below, so one unfilled gap here, one unfilled gap here, and lo and behold, it's a H&S formation. Okay, which again, like I said, all the other indexes that we've observed all have the same potential scenario. So that's not a good sign, is it? The building sector are now, given the fact that Mr. Carney has talked about higher rates, that's not exactly bullish for the building sector. Although we do see seem to close at the highs, etc. But again, on the 10-minute chart, you can clearly see here you've got a case for a H&S formation. There's your left shoulder, your head, and your right shoulder, and down we go. Okay, so keep an eye out for that. Okay, your H&S formation. I'll just draw it for you, make it easy. There's your neckline. So your left shoulder's here, head, and then obviously your right shoulder, as we already know, horizontal resistance here, and then obviously looking to propel and move lower. So again, that strengthens the argument for the FTSE to move lower. Okay, and I've already mentioned with regards to the Aussie and Kiwi, the FTSE 250 again certainly has propelled higher. Although having said that, we certainly seem to be into some potential resistance scenario here, so watch out for that. Okay, so bear with me. Okay, so we did fail this inverted the H&S formation, so we are potentially looking for a retest there. Excuse me. Okay, so 10-minute chart certainly isn't looking well. We are assuming we double top intraday today. We've been making lower lows and lower highs, so expect that. And then obviously you've got an unfilled gap below, so watch out for that. So lower lows, lower highs ever since the sterling started to move higher. Okay, so given the fact that the US data was very, very weak today, or it's 12 o'clock now, so past 12, so yesterday, that certainly doesn't give sterling the ability to reverse, and given the fact that Mr. Carney's hawkish, then sterling will continue its movement ascent higher. As you can see here, the next stop more than likely looks like the 200 MA or the 1.6950 level. Okay, now let's go to the FTSE 100 itself, and let's see if we can try and break this down. Okay, so let's start with the 60-minute chart first of all, now that we've observed all the particular indexes in the sector. This is an old H&S that didn't really transpire, so let's get rid of that. Okay, let's get rid of this. This is really a key trend line that we're watching. Okay, so what do you notice here straight away, folks? Okay, I notice a H&S formation. Yeah, there's your OPEC H&S. Okay, so there's your whole, there you go, exactly the same pattern that we're observing on pharmaceutical index, the banking index, the retail index, okay, the building and construction index, etc, etc, etc. Okay, so that's something that we're going to keep an eye out for. You've got an expanding wedge pattern. Again, that's not exactly a bullish sign. You've got an unfilled gap below that needs to close, so watch out for this gap at 6670 to close. And that basically means to me that there's going to be some type of bearish catalyst overnight that will allow that to close. So again, we'll see. And obviously OPEC is the only thing that I can think of right now. This Chinese article about lowering growth again, and given the fact that the US market short squeezed late in the session based on some rumour about the PBOC, again, from my perspective, sounds like it's all a load of horse or BS, because the US market's wanting to short squeeze as high as it could going into the Thanksgiving holiday and Cyber Friday, etc, etc, or whatever you call it, Black Friday. But having said that, remember, you know, we've had Ferguson overnight. There's talk about 20 other cities now, protests going on there, scuffles breaking out, and also talk about Black Friday being basically boycotted due to this situation in Ferguson, okay, and this race rights and etc, etc, with it being an issue, and it can be a political uncertainty as well in the US, and again that causes uncertainty. Any uncertainty causes the stock market to sell off. So there again, H&S formation, the FTSE 60-minute chart, expect this move lower to test this the lower trend line. Okay, so 10-minute chart, the FTSE 100 certainly is a mess, really, to be honest with you. But like I explained, we've really made this double top here. Obviously, the market now looking to make a lower high, and then looking for a potential test over here, or should we say down below, looking at least 6705 to be tested tomorrow. If the OPEC cut obviously still continues to have a negative effect, then or should I say non-OPEC cut has a negative effect, then expect this gap here at 6,680 to be closed. So these are all the potential scenarios and the potential outcomes that I expect to happen or occur tomorrow. Definitely 6,705, potentially 6,680. Obviously, the only thing that could negate that is this light volume stupidity continuing its ascent, and also given the fact that OPEC does actually cut, obviously that will help. And also, if there is any potential talk or confirmation of this so-called additional Chinese rate cut or any stimulus measure overnight, or even talk of Mr. Zhu being ejected. So again, these are all factors that will shift bias and obviously invalidate this potential setup that I can see before me. But that's the market, folks. We have to obviously base our trade decisions on the available information at this time. Any additional information that comes in, then obviously that then is subject to change. I will have to change accordingly, and obviously I will change my bias and my understanding and interpretation that goes along with that. So that's the markets, folks. We can only assess and review and base our trading decisions on the information that's available, and that's basically what I deem to be available and what I've read and understood and my interpretation of it thus far. So number one, OPEC cut, negative. OPEC, lack of OPEC cutting is negative, okay, because it will put pressure on commodities, especially oil, not gold, or other commodities. If anything, gold will catch a bid because the uncertainty with regards to OPEC and money potentially flowing out of oil into gold. Okay, so that's one scenario. Okay, now the other scenario is the fact that we've had this Ferguson situation in Ferguson. Also Russia-Ukraine certainly seems to be brewing in the background. So there's two geopolitical events that could potentially cause the gold prices certainly to sky high, dollar to potentially catch a bid, and the stock markets, the equity markets, to sell off. Which I'm surprised, to be honest with you, the equity markets didn't sell off today. We've had weak economic data out of the US, very weak, or today, or overnight. So again, that will obviously hurt sentiment, especially with consumer confidence today before being weak. So again, equity markets certainly coming under pressure and not justifying the current value, given the fact that the S&P and the Nasdaq just made a new high. So again, these are all factors. So from a fundamental perspective, and technically, it doesn't look very strong at all. The market's not made a high today. So again, that's a warning sign that the market's exhausted, especially in Europe, and looking for a potential reversal. Okay, folks, so risk on, risk off, wax on, wax off. Goodbye now.